Good morning, traders. Today is Wednesday, the 8th May 2024, and here are key things you need to know. For today's US dollar index is currently trading above 105.3, showing a slight increase. This movement in the market is influenced by the Fed Reserve, Jerome Powell's cautious remarks regarding the uncertain path of inflation, despite recent signs of easing. Like Powell, other Federal Reserve officials are worried about the persistent inflation, despite her historically tight monetary policies. Unless there's an official statement from the Fed, the dollar isn't expected to make major moves this week. Earlier this week, the index dropped more than 1.4% from its peak in April, but has since recovered from Friday's lows. However, buyers have been cautious recently, especially after the Fed's last meeting took a more cautious stance and due to the disappointing US job data. The decline in the bond yields in May has increased expectations for new interest rates policy, which has negatively impacted the dollar performance recently. For technical analysis, the signals for the US dollar index are somewhat mixed right now. The RSI is indicating increasing selling pressure, suggesting a bearish trend. The index has fallen below its 20-day EMA, which is a short-term bearish signal. The key levels to watch include support at 104.43, a significant price level based on past trading, and the 200-day moving average at 104.23, indicating potential longer-term positive momentum. Short-term resistance levels to keep an eye on are around 105.53 and 105.8. And then for the crude oil, prices were around $78 a barrel during Asian trading on Tuesday. The prices dipped slightly following an Israeli attack on the Gaza. The ceasefire talks are ongoing but haven't reached an agreement yet. The Israeli forces targeted Rafah, which is a city in Gaza, leading to concerns as it houses over 1 million displaced Palestinians. The Hamas agreed to a ceasefire mediated by others, but Israel rejected the terms, saying they didn't meet their demands. This conflict in the Middle East has raised worries about possible disruptions to oil supplies in the region, which is supporting oil prices. The WTI US crude oil prices are expected to trade around 78.5 per barrel, with buying orders at the same price, amid discussions of a possible ceasefire. The recent negative sentiment in the oil market has pushed WTI prices down from last week's high of $83. Since the beginning of May, US crude oil prices have dropped by about 3%. WTI has closed lower for 6 consecutive sessions and is now below its 200-day moving average of $79.8. If the decline continues, the price could drop back to last week's low of around $77.64 per barrel. Further downward movement could target $77.26, which is 125-day moving average, and a trend line originating from the low of $75.46 on February 12. The next significant level of support is around 75.46, which is the low point of February 12. On the upside, the first resistance levels to watch are the 200-day moving average at 79.8 and the psychological level of 80 per barrel, which could act as a cap on any upward movement in prices. The gold prices initially dropped to $2,310 during the European session, but later rebounded to around $2,330. The 10-year US Treasury yield stayed below 1.5%, which supported gold prices. However, the US market lost momentum and gold fell back to $2,310 due to a stronger US dollar. Despite this, the recent US employment data has led to expectations that the Federal Reserve may cut interest rates later this year. This anticipation of rate cuts could drive gold prices higher by making it more affordable for foreign buyers. The central bank purchases and demand from Asian market will continue to boost gold prices in the short term. Additionally, the ongoing political tensions in the Middle East could lead to increased safe haven buying, benefiting gold prices. Any hawkish comments from the Federal Reserve officials, like the Minneapolis Fed President Neil scheduled to speak later, could strengthen the dollar and potentially lower the gold prices. The gold outlook remains positive despite recent weakness. It's trading above the 50-day key moving average at $2,246. In the short term, it's within a downtrend channel since mid-April, but with bullish momentum indicated by the 14-day RSI around 53. The next targets for gold are breaking above the downtrend channel upper limit around 2,350 to 2,355, followed by resistance at 2,400 and the all-time high near $2,431. The support levels include 2,300, 2,288.8, which is 50% Fibonacci retracement, and 2,275 May 3 low. These levels are crucial for the gold futures direction. And then for the AUD USD, it faced weakness against its counterparts in early European trade on Tuesday, retreating below the key level of 0.66 amid a rebound in the US dollar and general risk aversion sentiment. This reversal followed by the reverse Bank of Australia's decision to keep the interest rates unchanged at 4.35%, with Governor Michael Bullock hinting that the potentially more hawkish stance given stronger than expected inflation data. The AUD USD halted its recent winning streak as investors digested the RBA's policy decision and statements. Governor Bullock emphasized that current interest rates should support inflation returning to target levels, suggesting no immediate need for further policy tightening. On the daily chart, the AUD USD consolidates with the symmetrical triangle formation with the 14-day RSI, signaling a bullish bias above 50, currently at 57.9. The major resistance lies near last week high at 0.6648, with potential upside targets at 0.6676, 61.8% Fibonacci retracement level, and psychological levels like 0.67. The immediate support levels for AUD USD include 0.66 and the 9-day moving average at 0.6556. A breach below these levels could expose the pair to further downside towards 0.65 and the lower boundary of the symmetrical triangle around 0.6505. For our GBP, the pound experienced a sharp decline against the dollars as traders anticipated the upcoming monetary policy decision from the Bank of England later this week. The GBP USD has been consolidating within a range of 1.25 to 1.2595 over the past few days, with most of the gains they erased during late US trading on Monday. In the recent developments, improving risk sentiment initially weakened the US dollar at the start of the week, but the comments from the Fed Reserve officials during the US trading session boosted the Treasury yields and bolstered the dollar against its counterparts. The absence of fundamental drivers and high impact data releases may lead GBP USD direction to be influenced by the risk sentiment and geopolitical developments. On the daily chart, the GBP USD is approaching the 180-day moving average 1.2527, coinciding with the 38.2% Fibonacci retracement level at 1.2526. If this level holds as support, the pair could target psychological levels at 1.26 and 1.2596, followed by 1.2666. The key resistance levels above current levels include 1.255, beyond which buyers might step in. On the downside, immediate support lies at the psychological level of 1.25, with further levels at 1.2474, 1.248, and 1.2439, with potential attention towards the psychological level of 1.24. For the Japan yen, rebounded after a decline last week attributed to possible intervention concerns and weak US jobs data. The pair is trading around 154.6 during the European session, benefiting from a corrective move in the US dollar. However, headwinds persist due to investor optimism stemming from disappointing US non-farm payroll data released on Friday. The Japanese monetary officials continue to hint at intervention measures to combat excessive market volatility, adding uncertainty to the path ahead for USD Japan yen. Data from the Bank of Japan indicates significant interventions to support the yen in recent days. On the daily chart, the USD Japan yen finds support near 152 in the short term, experiencing a recovery from short covering. However, the downward pressure persists due to intervention concerns. The key levels to watch for potential upward trend include resistant levels around 154.95, 155, and 155.16. Breaking above these levels could lead to further tests at 155.944 and 156.28. If the short-term recovery faces resistance near 154.95, 155, and 155.16 area, the USD Japan yen could reverse lower due to market sentiment influenced by intervention fears. The downside targets include 153.83, 153.33, and psychological level at 153. For Euro USD, a resurgence of USD buying bias has weighed on risk related assets, pushing Euro USD back towards the 1.075 area after failing to retest the 1.08 level. In early European trading on Tuesday, the pair remains in consolidation near 1.075, with the near term technical outlook suggesting weakened bullish momentum. The Euro USD struggled to find clear direction at the beginning of the week amidst the absence of significant data releases. While improving risk sentiment initially weakened the dollar's demand, hawkish comments from Federal Reserve officials helped limit losses for Euro USD. However, disappointing factory order data from Germany added downward pressure on the euro. On Monday, the Euro USD approached key 1.08 mark, coming close to breaking above the 50-day and 200-day moving averages. The bears are keen on keeping the price below these technical indicators to halt bullish momentum. A break above could trigger a rally towards 1.08112 and the key Fibonacci barrier at 1.087. In case of a bearish reversal from current levels, traders should monitor 1.0728 as a crucial support area. Further downside targets include 1.0695 and 1.0645. A stabilization around 1.0645 could precede another potential upward move. However, a breakdown below this level may lead towards 1.06. And that is the end for today's daily analysis. Thank you for watching, and if you're interested, feel free to reach out to our channel.